Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
The Dow Jones closes above 35,000 for the first time. Facebook has become the next $1 trillion company. United Airlines and Delta's CEOs say their airlines should be profitable by the end of 2021. And this week, it was reported that life expectancy has dropped by a year and a half. So don't wait for what you've been putting off. That and more tonight, all on Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up, and I hope your week went well. I'm Andre Laborde. Our goal is bringing Wall Street to your street for today, Friday, July the 23rd, 2021, and to get you ready for the week ahead. Tonight, we're going to be talking with Tom Vartanian. Tom is a former general counsel for the Federal Home Loan Bank Board and the FSLIC. He's just written a book called 200 Years of American Financial Panics and Crashes, Recessions, and Depressions. By the way, there have been 10 of them in the last 200 years, and there just possibly could be more. And he'll be with us tonight. But first, how did the markets do this week? Well, the Dow Jones Industrial Average ended the week at 35,061, up 238 points for the day and up just over 1% for the week. The S&P 500 closed today at 4,411, up 44 points for the day and up almost 2% for the week. And finally, the NASDAQ. They finished the week at 14,831. They were up 152 points for the day and up 2.8% for the week. And as I mentioned earlier, the Dow Jones closed above 35,000 for the first time, and Facebook crossed above the $1 trillion market cap as well. Evercore Securities and JP Morgan both raised Netflix to a new price target. Evercore put Netflix now at a $635 price target for their shares, and JP Morgan raised Netflix shares to a $600 price target. An analyst at Mizuho Securities upgraded Square as a strong buy at $380. In fact, they said buying it now, talking about Square, is like buying JP Morgan in 1871. That's what they said. Well, my guest this evening is an expert in the financial industry for over 40 years. And in the course of that time, he's been general counsel of the FSLIC as well as the FDIC. And he's been in the Treasury Department, named as one of the best financial service lawyers in America. Plus, he's got a great book out about the 10 financial crises of the economy. His name, Tom Vartanian, and he's with us tonight. Hi, Tom. Welcome to Wall Street Wrap-Up.
Thank you, Andre. It's great to be here.
When it comes to financial panics and bank crises, that there have been 10 of them over the last 200 years, that it happened in the past, and because it's human beings, it will happen in the future. And second, I took away from it is that what occurred, really the grounds that, the seeds that were planted were for something that occurred maybe 5, 10, or more years earlier by some government regulation that then the public sector started adding, as you use a term, brick by brick from a first government regulation. Is that right?
Yeah, absolutely. I mean, this book has been 45 years in the making, which is really as long as I've been a regulator and then a private practitioner representing some of the largest financial institutions in the world. And what I saw when I was in the government handling the savings and loan crisis back in the Reagan administration was that it was a crisis largely created by government policy. Now, I say that with no criticism, because what Congress was doing was well-intentioned at the time, and what it was trying to do in 1966 was to foster as much home ownership as possible, not understanding and not realizing that by 1980, what that would result in would be putting savings and loans in a huge mismatch and basically unable to deal with the interest rate scenarios that occurred in the early Reagan administration. So When I was sworn in, Andre, at the Federal Home Loan Bank Board as general counsel, on that day, the 6-month T-bill was about 14.5%, and inflation was around 12%.
Hmm.
And the Congress never anticipated those kinds of markets, but it was what they did and what the states did in the 15 years prior that caused the savings and loan crisis. And what I found is this keeps happening again and again and again.
As I think, as Mark Twain used to say, history may not repeat itself, but it sure does rhyme. There probably, Tom, people that are over the age of 25 will know very much of the panic and the fear that occurred in the 2008 banking crisis. But like you brought up in your book, that the seeds that were planted were from regulations like even from 1968 and 1970 of being able to securitize the mortgages that Fannie Mae and Freddie Mac were getting from local banks. Is that right?
Yeah, absolutely. And it goes back to the point you made just a minute ago about the fermentation over a long period of time of these rules that turn into financial crisis. And so I worked on the creation of mortgage-backed securities in the 1980s. And interestingly enough, there's a book by Joan Nocera and Beth McLean called All the Devils Are Here that attributes the 2008 crisis back to a genesis date. And the genesis date that they pick is a meeting that I had with Secretary of Housing Sam Pierce, representing 5 of the large investment banks on Wall Street, arguing to Sam Pierce that he should prevent Fannie and Freddie from getting into the REMIC mortgage-backed securities market. And Joe and Bethany conclude in their book that it was the loss of that argument and the allowance of Freddie and Fannie into the mortgage-backed REMIC market at that time that basically gave them ultimately the dominance of the mortgage-backed securities market, which ultimately caused part and parcel of the 2008 crisis, 20 years later.
Yeah.
So it was that sort of unwinding of things that occurred over a 20-year period. And then the Clinton and the Bush administration trying to increase home ownership by forcing the banks to lowering their underwriting standards that caused 2008.
So this was, in fact, I'm glad you brought that up because this was before when Bill Clinton with, I think it was the Department of Housing and Urban Development, was pushing for more home ownership of lower income families, which in theory sounds very good, but many times when that happens, they're not able to pay. But by pushing this to be making it almost like a mandate, banks were almost forced to be able to make loans that they knew that they would eventually have to write off.
Yeah, so 2 things happened at the time. And again, all well-intentioned by our policymakers. But the Clinton administration concluded that home ownership in America is a great thing. And it absolutely is, right? It invests people in their country, in the future of their country. And so they decided that home ownership in America should go from 62% to about 66, 67%. So that would add about 8 million homeowners to the country. And they created policies to try to create these 8 million more homes and home buyers. Now, when you do that, everybody in the economy benefits from that, right? There's 8 million more homes being built by home builders. There's 8 million more washing machines being sold and 8 million more tons of carpeting and so on and so forth. And so it's a way of stimulating the economy and pushing the economy forward. At the same time, the Clinton administration forced the bank regulators to go after banks for not lending to low and moderate income families, accusing them of discrimination. So what happened? When the banks were told that they needed to find 8 million more home loans, you don't find them at the top of the credit ladder because those people have homes and they have the credit. You find them at the bottom of the credit ladder. And so standards were lower to satisfy the government's concerns and government's policies. And that ultimately became the subprime lending crisis of 2008.
And then, from what I understand, Tom, is that after Clinton left office, then George W. Bush, came in, number 43. And what happened was that he also accelerated the same thing that the Clinton administration did, which didn't put a stop to it, but only continued the problem and created more of so. Is that correct?
Yeah, absolutely correct. The Bush administration did the same thing in trying to push home ownership. And again, understanding that at first blush, you would say pushing home ownership is a fabulous goal. And often, not always, but often that results in distortions that create market disruptions and therefore financial crises.
Well, that's an excellent point of what you're bringing up, because when you're talking about the Clinton administration, so they ended in 2001. Then George W. Bush took over in 2001, which we then talked about how he continued that policy and actually pushed for more home ownership. And as you said, it wasn't that from the upper end of the economic ladder, but the lower end. But then the crisis occurred in 2008. So it took about 7 years of additional policies of what you're talking about to create the panic and the crises that occurred, right? It took that time.
That's absolutely right. That's absolutely right. So if you go back to the mortgage-backed securities issues in the 1980s, you really have a 20-year process of building what has become the largest financial crisis since the Great Depression. And my argument in the book is we should have seen it coming. We should have understood what we were doing, and we should have stopped it. And if we can use technology to regulate better, if the regulators in the government can use artificial intelligence, for example, to run predictive scenarios and understand where these things may lead, maybe we have a better chance of stopping these things from happening again. Because I have no expectation that we're ever going to stop politicians from doing things like supporting home ownership and supporting and spending money, right?
Right.
So, but what we can do is we can have better predictive algorithms and scenarios in front of us so that the regulators, the Fed and the government and the Treasury can understand that these are possible scenarios out in front of us and say, look, these three aren't really going to work, and these three are going to be catastrophic. We got to alter we got to fine tune the economy now before we get there.
From the crash of October of 1929, regulations were created, such as one is the Glass-Steagall Act. Now, for our viewers, at one time, banks could work also with financial institutions that buy and sell stocks. And then the Glass-Steagall was created so that they were separated. A commercial bank that dealt with depositors and such were not with being able to also buy and sell stocks as well. And then in 1999, under the Clinton administration, Glass-Steagall was removed, which now then occurs again to what we're talking about with the 2008 crises. Do you feel, in your opinion, is Glass-Steagall, that repeal, a good thing, or do you think it should be put back in?
You know, by the time we got to repealing Glass-Steagall, Andre, there were so many other regulations in place that it really didn't add to an unsafe or unstable environment. It was put in place after the Depression so that banks couldn't lend to entities for whom they were underwriting securities, because that would be a conflict of interest. At least that was the theory. Because it had been that way in the Great Depression, and there had been some problems that caused the Great Depression because of that. But we have so much regulation that's been created since then that removing that bar so that now JP Morgan can also be in the securities underwriting business is not necessarily, and frankly, has not been a cause of any financial crisis since the Great Depression. What I think is the great challenge of the future is not Glass-Steagall. I think that's the old world banking world. I think it is cryptocurrency. I think it is technology. I think it is artificial intelligence. Let me give you an example. When the Glass-Steagall Act was passed, and when all the banking acts that regulate these financial institutions were put in place in the 1930s, so it was 1932 to 1940, basically all of the structures and all of the laws we have today were put in place. Commercial banks and savings institutions basically controlled 95% of the economy and the financial services market. All right. Mm-hmm. Today, they control about 35% of that same market. And look what's happened. We haven't changed anything. So we have 100% of our prudential resources from the government regulating now, not 95% of of the markets, not overseeing and supervising 95%, but supervising just 35%, with lots of other risk hiding in plain sight in an unregulated part of the economy.
Since 2008, with the power of the internet today, it's like you said, when you wanted to get a home mortgage, you used to go to your local banker, and your banker would know you. Today, with internet, from everything from you never even go face to face with a banker or with your loan officer. It's all done online, and it's done no paperwork, all just online type of banking.
Yeah,
So,
absolutely.
as they call fintech financial
Right.
technology. Mm-hmm.
Absolutely. In the savings and loan crisis, at that time in the 1980s, just about 95% of the mortgages in this country are made by savings and loans. Commercial banks didn't make mortgages. There were very few, if any, non-bank entities, mortgage banks, mortgage lenders making mortgages. It was a savings and loan business. Turn around today, and banks and savings and loans are making the minority of mortgages in this country. Most of them being made by companies, fintech companies, mortgage lenders, mortgage brokers that are not regulated financial institutions. So again, the market has changed dramatically, and we haven't changed the regulatory apparatus that looks over it.
I understand. If you're just joining us, we're glad to have you. We're talking with Tom Vartanian. Interesting book. Tom has written a book called The Financial Crisis, 200 Years of American Financial Panics, Crashes, Recessions, Depressions. I've read it. I can certainly recommend it for you. We're going to take a break, but we'll be right back. Don't go away. And we're back. We're talking with Tom Vartanian. Tom, I remember when that Dodd-Frank bill was passed, they didn't finish writing the bill yet, and they passed the bill before it was even finished, because a lot of other things that they kept adding in after the vote. So I know our legislators didn't even read the bill.
Yeah, no, if you want an evaluation of the Dodd-Frank Act, and there was some parts of it, it was 2,500 pages, right? So you can ask yourself how many of those pages our legislators read, right?
Uh-huh.
But of those 2,500 pages, most of them were largely unnecessary. But you don't have to believe me. If you want to evaluate the Dodd-Frank Act, all you have to know is that Congress set up a commission to evaluate the 2008 crisis, come up with answers as to why it occurred, and then recommend solutions to Congress so it could write legislation to deal with it. The fact of the matter is that Congress finalized the Dodd-Frank Act 11 months before they ever got the recommendations from their own commission. Right? They couldn't even wait for their own commission to tell them what caused the crisis and what they should do to write the legislation, because they were reacting in sort of a knee-jerk way to the overwhelming financial harm that had been created in the country. And they wanted to say, we have done something. Well, the problem is they keep confusing action for progress. Action doesn't equate to progress. What they did is they wrote a lot of words, but the question is, are those words actually going to make the industry, the entire financial services industry, safer and more stable in the long term? I don't think they are.
True. What about and talking about Dodd-Frank and the other regulations that have occurred since then, Tom, in your estimation, you've got larger banks, J.P. Morgan, Bank of America, Goldman Sachs, others such as that. And then you've got the little smaller institutions that many people have, that is their small bank that is not outside of their area or outside of the region. And small banks are having to be under the same type of regulations as the larger banks. As a larger bank, you can absorb a lot of the cost of that regulations. What do you think the future holds for the small bank?
Well, Andre, that's really a great question, because I'll give you some numbers to show you what the trend is like. So in 1976, I started as a lawyer at the Office of the Controller of the Currency regulating national banks in this country. At that time, there were 21,000 national banks, another 6 or 7,000 savings institutions. Today, we're down, to something about 5,000 banks in this country. So you can see what's happened, that we have had an enormous shrinkage through merger acquisition. We've had what? We've had 5,000 bank failures in that period of time.
Hmm.
Just an enormous shrinkage, moving closer and closer to a more concentrated financial services system. And there's a great debate over whether that's good, bad, or indifferent. Well, look, I mean, there's the example of Canada, which has had traditionally six large banks, and that's about it. And they have had two financial crises in the last 200 years to our 10. So you can't necessarily argue that having fewer banks is going to be a problem. But we're a bigger country with a lot more people in a lot more rural areas. And we're going to have to figure out what to do as community banks continue to disappear and the larger banks become the dominant players in the marketplace. And we haven't thought about that. We haven't restructured regulation. And as you point out, we regulate them all the same way when they're not the same kinds of financial institutions. If you take a community bank, there is nothing about a community bank that looks like JP Morgan or Citibank, right?
Tom, something that concerns me, and maybe you can help me with this. There's an old saying, the definition of insanity is doing the same thing over and over again, thinking you're going to get a different result. Well, in the infrastructure bill that the Biden administration is now in the Senate to be voted on, there's a little known area that has not really gotten any press coverage whatsoever. Personally, I think because nobody's read the bill fully, but there's a part of it that the Biden administration wants to have low-income multifamily housing to go into the suburbs of single-family housing into the suburbs. And there is money to be able to do this. Well, the first thought is well, what about zoning? If a place is zoned for single-family homes, you're not able to have multifamily lower income housing if it's zoned. But the transportation department is going to be withholding transportation money, highway funds, unless zoning is rechanged. Now, I remember very well that, like, let's say in the Louisiana area, that there was a drinking and driving that you could be 18 years of age to be buying alcohol. Well, the federal government wanted to increase the age from 18 to 21. I know Louisiana was not wanting to do it. Well, Elizabeth Dole, who was the head of the transportation department at the time, said that you're not going to get highway funds until you raise the age from 18 to 21. Well, Louisiana raised the age. So I'm curious if whether or not, since money is like crack cocaine to politicians, if this occurs, that lower income multifamily homes will be put into next to single family homes in the suburbs, what effect will this have on banking and mortgages? Thinking about the 2008 mortgage crisis where mortgages were higher than the value of the home.
Yeah. What I would say to that, Andre, and it's a fundamental predicate that I think applies to most of the insane things that we keep doing over and over again, as you suggest, and that is just because something is a good political idea doesn't mean it's a good economic or financial idea. And what we should have learned over this 200 years is you can't legislate the economy. You can't force a certain financial environment to occur just because you want it to occur. And what happens is when we try to do that through these kinds of political ideas and manipulations of the marketplace, we end up with results that were not anticipated. And what concerns me about the way that we do all these things is not that that's not a that people shouldn't have that idea. People should be housed in the best way that they possibly can be throughout this country. But Congress isn't going to be the answer to that question. The market's going to be the answer to that question. And when is the last time you saw a cost benefit analysis done by the Congress about any of these wild legislative proposals that are put out there some of which have a lot of merit, right? We do things without knowing one iota about the cost-benefit analysis. The best example I can give you is the Dodd-Frank Act. 2,500 pages of legislation fundamentally changing the financial services business. And before the act was debated, while it was debated, and after it was passed, the government has never done a cost-benefit analysis. So think about that. We passed 2,500 pages of legislation not knowing whether they would help the economy or hurt the economy. That's not the way to run the largest economy on the face of the planet. We ought to know the effects of what we're doing. So in the case that you bring up, I would say somebody ought to tell us what the effect is on mortgage markets, what the effect will be on real estate markets, what the effect will be on real estate values, and take all that and use technology to try to figure out what the long-term effect is going to be, rather than just saying, let's try this and see if something sticks to the wall and makes sense.
True. Tom, I've got a lot more questions. I hope you come back.
Well, let's do it again. This is a lot of fun.
Thanks, Tom. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. You can write us at andre@wallstreetwrapup.info. Keep it pithy or concise. We'll be glad to answer your questions. And now for a look ahead for next week. But first, President Ronald Reagan designated the month of July for what favorite food? We'll have the answer in just a minute. Well, President Ronald Reagan designated the month of July for this favorite food. What is it? Answer is ice cream. In 1986, President Reagan designated the month of July as National Ice Cream Month, and specifically the third Sunday of July as National Ice Cream Day. And with all the different flavors, still the most popular flavor, still vanilla. Well, many of you in our viewing audience may have T. Rowe Price mutual funds or possibly may have them in your retirement account. Sebastian Page is not head of a specific mutual fund, but he's head of the Global Multi-Asset Division with assets under management of over $400 billion. His decisions move markets, and his decisions is what we'll be discussing next week. Next week, my guest will be the head of T. Rowe Price's Global Multi-Asset Division, Sebastian Page. You won't want to miss it. And also, coming up in the weeks ahead, we're going to be discussing the travel and business industry with airline industry with the former CEO and chairman of United Airlines, Oscar Munoz. And we'll also be talking about health care with the Delta variant and COVID and such with the president and CEO of Ochsner Hospitals, Warner Thomas. All coming up ahead. And we also play the show, remember, on Sunday mornings, but the best way is to set your DVR so you'll never miss a show. And that's our show for Friday, July 23rd, 2021. I hope you've enjoyed it. My thanks to Tom Vartanian tonight, and my thanks to you for allowing us into your homes. Remember, you can always follow us on Facebook and WYES.org. So have a great weekend and an even better week ahead. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.